This chart highlights a strange disconnect. Consumer sentiment has dropped to historical lows, while the S&P 500 pushes toward all-time highs. Shatter that index, and the illusion disappears. A tiny tier of AI assets rockets upward, dragging the average, while the vast majority decline. This has created a split economy. On Main Street, most people are feeling the weight of rising costs and stagnating wages. On Wall Street, the narrow group of investors with exposure to specific tech winners is thriving. In this environment, the traditional advice to diversify across the entire market can actually backfire. By spreading your capital too thin, you mostly own the laggards, diluting your exposure to the few companies actually driving the growth. The reality hidden by the market illusion is that wealth isn't growing evenly. It is concentrating into a microscopic fraction of the world's most productive assets. To understand how rare these winners are, we have to look at a century of market data. Researcher Charlie Bolello analyzed the performance of every public company over the last 100 years. Out of 30,000 public stocks tracked since the early 20th century, just 86 generated over half of all market wealth. Those 86 winners represent just 0.3% of the total pool. The remaining 99.7% barely managed to create any net value over the long term. Historically, some of these winners were retail giants that scaled through massive physical expansion, building thousands of storefronts over several decades. Others were found in the energy sector, powering the industrial age. But these giants are being overtaken as wealth generation shifts toward a new paradigm. The AI revolution is now accelerating this concentration. Because the compute and energy requirements are massive, the winner's circle is shrinking further, funneling capital into an even smaller handful of companies. Historical data suggests if a portfolio misses this top 0.3%, it is left holding thousands of companies that fail to generate significant growth. In the coming decade, finding the needle in the haystack isn't just a strategy, it's a requirement for survival. AI has moved beyond software and into the physical world. It is consuming a massive and growing share of global hardware, compute power, and electricity. We can see the scale of this shift in data center construction. In 2016, spending was just $3 billion. Today, it has reached $447 billion, even as construction for general office space has stalled. To stay competitive, tech giants are aggressively hoarding specialized chips, striking multi-year deals to ensure they have enough compute power to keep their AI models running. Tesla is a prime example of this push into the real world. By deploying its unsupervised, full self-driving software, it uses a fleet of vehicles to gather massive amounts of proprietary driving data in 37 different cities. This rollout currently covers 175 million people, roughly half of the entire U.S. population. That scale gives them a data monopoly that is nearly impossible for competitors to replicate. The clear winners of this era are the rare companies capable of monopolizing physical compute and real-world data at a scale that the rest of the market simply cannot reach. This 0.3% rule doesn't just apply to stocks. It also applies to the world of mathematically scarce digital assets, most notably Bitcoin. There is a silent drain happening on crypto exchanges. In 1 month, reserves fell by 100,000 Bitcoin to 2.6 million. Even during market stress, long-term holders didn't panic. They continued to pull coins off the market, signaling the major selling phase has ended. Wall Street ETFs are a primary engine of this drain, absorbing massive capital through consistent multi-week inflows from institutional investors. At the same time, major corporate whales have entered a hyper-accumulation phase. Michael Saylor's MicroStrategy, for example, has increased its buying pace to thousands of Bitcoin every single week. These institutional buyers are focused on the simple mechanics of scarcity. When you aggressively drain the open supply of a strictly finite asset, the price is forced to move upward. This leads to the ultimate question. Why are these massive institutions so desperate to hoard physical AI infrastructure and scarce digital assets right now? They are preparing for a historic debt crisis. Projections show that global debt is on track to surge past 102% of global GDP by 2031, a level rarely seen in human history. Historically, when debt reaches these levels, governments have very few options. The most likely path is to print more currency to service that debt, which inevitably devalues the money people hold in their savings accounts. Over 100 years ago, Henry Ford predicted that a new type of energy currency would eventually replace gold to provide a more stable foundation for the global economy. That prediction is being fulfilled today through the fusion of AI's massive energy consumption and Bitcoin's digital scarcity. Both represent a move towards assets that cannot be devalued by a printing press. The middle ground of the global economy is disappearing. To navigate the coming years, the strategy is clear. Look past the 99.7% of market noise and concentrate your capital into the hardest assets and the handful of technology winners driving the future.